This is the Asia Trade. I'm Paul Allen in Sydney, where the markets have just opened.
And I'm Avril Hong in Singapore. The top stories this hour. Further yen weakness looks set to support Japanese stocks even after Wall Street fell on comments from the Fed chair, signaling no need to rush on rate cuts. Asian EV makers will be in focus after a report that Donald Trump wants to end a U.S. tax credit. That sent U.S. peers lower, including Elon Musk's Tesla. And vaccine makers also taking a hit as the president-elect taps industry critic Robert F. Kennedy Jr. as his health secretary.
Well, it's Friday here in the Asia Pacific. Let's take a look at how US futures are tracking at the moment. A little bit softer, and we did see most of the major US markets retreat a little bit today. US dollar strength still very much a theme. We saw the PPI index ticking upwards. Jobless claims in the US also dropped to the lowest since May last week. Those are initial jobless claims anyway. So data still showing that the US economy is strong. Markets perhaps trimming their bets on where we go from here in terms of rate cuts. And we did hear from Jay Powell a bit earlier. He says that, speaking in Dallas, that he's really continuing to riff on this easy does it approach. And if the data lets us go slower, well, it seems like the right thing to do. Let's take a listen.
The economy is not sending any signals that we need to be in a hurry to lower rates. The strength we're currently seeing in the economy gives us the ability to approach our decisions carefully. Ultimately, the path of the policy rate will depend on how the incoming data and the economic outlook evolve.
Paul, no rush to ease really playing out in the greenback, as well as dollar yen marching ever closer to levels that last prompted intervention from Japanese authorities. 2 rounds, remember, that we know of in July. And of course, we are keeping a close watch on Nikkei futures that are pointing to some declines, might be an extension of what we've already been seeing earlier in the week, part of that risk off. But don't forget, we have Japan GDP numbers due later in the hour. We're expected to see a climb down, a slowing from the second quarter. The mega banks also in focus as they raise their profit guidance for the full year, certainly among the sectors that are benefiting from higher rates. Now, we have U.S. crude futures sitting a bit softer. The IEA, International Energy Agency, talking about how the world faces 1 million barrels a day more in terms of supply next year. And this is not just because of China's macro weakness, but also think about how we're amid the shift to EVs as well as high-speed rail. So that's what we're seeing across assets. Our executive editor for Asia markets, Paul Dobson, joins us now. So Paul, we just heard there from Powell. What exactly have we learned in terms of anything new from the Fed chair?
Yeah, so I don't think that Powell told us anything that the market hadn't already been starting to factor in. The idea that the Fed is going to start going more slowly with its cuts on interest rates. We talked earlier in the week about this idea that maybe the Fed will move to a pattern where it starts to cut 1 month and then skip the next one. And so the market pricing for December is back to 50-50, which is where it was 2 days ago. On the other hand, you know, the takeaway is that Powell is starting to sound a little bit more hawkish, like more members of the Fed. And so all things being equal, that is pushing up interest rates across the Treasury yield curve and also supporting the dollar.
When you hear from Powell and other Fed speakers how they seem to be more concerned about inflation, it gives you the sense that, you know, going ahead into next year and potential Trump tariffs, how that might play out. Taking that in mind, along with the greenback strength, what's that going to mean for Asia?
Yeah, so it's going to blow back on Asia's markets, particularly via the dollar, right? As long as US interest rates are likely to be supported, that's likely to keep on pushing the dollar higher. It's been on quite a tear since the US election, and that's, you know, going to cause some pain across Asia's markets, right? Not just Japan, which is an obvious one where we have the yen weakness, but also across, you know, the likes of Southeast Asia, where the currencies will come under pressure. That may force central banks in our region to keep their interest rates higher than they would otherwise want to have them as well. And so that inflicts some pain on the economy, slows down growth too. So it sort of has this kind of you know, negative kind of wind blowing all across the region's markets as a result.
Yeah, and Paul, what about the impact of the US dollar on emerging Asia as well? Do we see any respite coming there?
So, so long as the Fed keeps giving this idea that it's going to be slower cutting interest rates and that the terminal rate might be higher, that's going to, kind of continue to support the dollar. And so, in terms of where that relief could come, obviously it can't run forever. But I think that we're starting to hear central bankers or policymakers across the region sounding a little bit more on edge about what they might do to push back against currency weakness in the various jurisdictions as well. So that might balance it out a little bit. We saw, I think, particularly influential is what China's doing. They're starting to set the FX fix below where it might otherwise be the case, showing some pushback against too much yuan weakness. That does drop a bit of an anchor for the rest of the Asia region. But on the other hand, there's very little that we can do when the dollar really is swinging into one of those bigger uptrends.
All right, our executive editor for Asia markets there, Paul Dobson. US President-elect Donald Trump wants Robert F. Kennedy Jr. to run the Department of Health and Human Services. Vaccine makers fell on first reports that the prominent industry critic could get a top role in federal health policy. For more, let's bring in Bloomberg's political news director, Jody Schneider in Washington. So, Jody, why is RFK Jr. so controversial as a pick for this role?
Well, it's not only who he is, but it's the particular role. Robert F. Kennedy Jr. has been a vocal critic of vaccines and things like fluoride in the drinking water, some really unorthodox health views that he proposed first as a presidential candidate, and he was going to be a Democratic candidate, then he was independent. Then he decided to join Donald Trump's quest for president after he dropped out of the race himself. And in all those appearances he made while running and while working with Donald Trump, he really came out against a lot of parts of the healthcare system. So to have him head the Health and Human Services Department, which oversees a broad array of agencies, everything from Food and Drug Administration to the health departments, things like the National Institutes of Health, somebody who has really gone against the mainstream in terms of health policy, that's raising a lot of eyebrows in Washington and a question of whether he could be confirmed by the U.S. Senate for this role.
Yeah, Jody, I think eyebrows already raised with other controversial nominations. Gates for Justice, Gabbard for Intelligence. What are your thoughts on confirmation and whether all these can actually make it through the Senate?
Yeah, that's the real question right now. How are they going to move through the confirmation process? They will need a majority. They do not have a whole lot of extra seats. The Republicans are 53 to 47 Democrats, and a number of Republicans have started questioning some of these picks, including, of course, Mr. Gates for Justice, and now Robert F. Kennedy Jr. for Health and Human Services, as well as Tulsi Gabbard to run the intelligence services when she has no experience in that area either. Donald Trump clearly is prizing loyalty above all else in making these picks, these three individuals, as well as others named in more what are being viewed in roles to which they would have more experience, but they've all been loyal to the president-elect. They will need this confirmation, and there's a question as to whether if it doesn't look like some of these votes will be coming through, whether they could even be withdrawn. But that process will start in the new Congress. Right now, we are still in a lame duck session with the previous Congress running the show.
Jody, also regarding Matt Gaetz, what's happening with the House Ethics Committee report summarising an inquiry into misconduct allegations against him?
Yeah, that's right. There's a lot of pressure now. There was this House ethics investigation into allegations of sexual misconduct with underage girls. There was a Justice Department investigation of him. It did not move forward. It did not have any findings. But this House ethics investigation is something even senators, even Republican senators now are saying they want to see before they can, they want to proceed with confirmation hearings. That this is very important. Somebody for the nation's top law enforcement job, if this investigation comes out and says there was this kind of wrongdoing, they're saying they want to know that before they proceed. Whether it will come out is a question. Mr. Gates has left the Congress and is now an ex-congressman.
All right, political news director Jody Schneider there as we continue to get names for the new Trump administration. We've got some breaking news out of Peru as well. China's President Xi Jinping has just arrived for the APEC arrival ceremony. He's made a few remarks, very brief remarks, according to the Ministry of Foreign Affairs. Xi wants to push for an open Asia-Pacific economy. So we'll bring you more lines as we get them, but of course Xi Jinping's in attendance. President Biden has of course only got a few months left on his term, and President-elect Donald Trump not there. So into this void we see Xi Jinping stepping into the Royal Palace in Lima in Peru, saying that he wants to push for an open Asia-Pacific economy. Still to come on the Asia trade. Knight Frank's Group Chair William Beardmore-Gray is going to join us for an exclusive look at their Asia strategy. Xero's CEO gives us the software company's outlook after shares extended a record high on strong earnings. Also, UBS is going to help us preview today's China data release for signs of stimulus kicking in. Much more ahead. This is Bloomberg. The prospect of a Trump presidency and a more protectionist world is looming large as leaders gather for the APEC summit in Peru. Chinese President Xi Jinping is at the National Palace to meet with Peruvian President Dina Boluarte and says he wants to push for an open Asia-Pacific economy. Xi is set to hold talks with President Biden, who also arrived in Peru just a few moments ago. Bloomberg surveillance co-anchor Lisa Abramowitz joins us now from Lima on the sidelines of the APEC CEO summit. Lisa.
Thank you so much, Paul. I am here, and I have to say, with someone who is present from the United States, who is Karan Bhatia, who is the head of global and government affairs for Google. Karan, thank you so much for being here. I want to start there. We see a lot of Chinese presence here. Xi Jinping arrived. He is christening a huge port that is just north of Lima. We do have Joe Biden here, but not as many U.S. companies. Has that been remarkable to you as a U.S. company here on the ground?
Well, Lisa, look, I can tell you we at Google have been pleased to be part of APEC actually for many years. It's an institution that, from our vantage point, focuses on the right things. It focuses on the way governments and the private sector can work together, sometimes in novel ways, to create solutions to issues and then see how do you scale that out over this incredibly dynamic region that's represented by all of the APEC economies. So we're happy to be here. Would love to see a lot of other American companies here as well. But look, I think these are the kinds of markets and institutions that are going to demand American companies be present. And I think we're going to continue to see growth in that.
There is this question, and it's sort of the elephant in the room that we've been talking a lot about, Donald Trump being the next president and having a harder line, at least in rhetoric, when it comes to international investment. How much has that dominated conversations that you've had with people, particularly about your expansion here? I mean,
in all honesty, I've been here today. The conversation actually has mostly been, and I've been meeting with foreign ministers, government officials, has really mostly been about how can they get the benefits of this amazing new technological revolution that's happening around artificial intelligence. So they want to hear about what can they be doing in terms of building infrastructure? What can they be doing in terms of skilling their people? there's an awareness that there's geopolitics that impacts the technology sector as well as everything else. But frankly, it's been interesting to me to see how much interest and appetite there is around getting that technological edge.
So how much have you been surprised, or why is it important for Google to be so heavily invested in areas like Latin America, like Southeast Asia?
Well, look, first of all, it kind of starts with our mission as a company, which is to organize the world's information and make it universally accessible and useful. And that universal part is really core to our being. It's a recognition that Google's not fulfilling its mission if we're not operating in places like Latin America, like Southeast Asia, East Asia. So I think part of it literally has to do with what it is we do every day. And as the technology expands and as our business expands, these regions become more and more important. Obviously, you can't look at the growth that's happening in places in East Asia. Latin American markets are doing very well and not be encouraged by sort of what we're seeing.
How much do you feel like some of the ambiguity around policy, around what's considered national security with chip exports, how much is that crimping your ability to expand, other companies in the same arena to expand?
Look, business always loves complete certainty and security, right? So we would be quite happy if there were defined regulatory environments. We understand and acknowledge that this is a novel time. It's new technology. Governments are still trying to get their head around how to regulate it. We would love to see more alignment between governments around the world, more discussions around it. But we recognize that there's going to be some amount of fluidity here as the world sort of starts to regulate it. What's exciting and encouraging, I think, is that we are seeing more discussions happening around this space in terms of global fora, things like APAC or the G20 or the G7, the OECD. And we are certainly also seeing governments not waiting to invest in the technology and to see how they can bring their countries along in this revolution.
Well, do you feel like you could be expanding much more quickly if there were more certainty?
Look, I think policy certainty is unquestionably one driver of the growth of the technology. So yes, I do think that would be helpful. Frankly, I also think policy certainty around some of the enablers of the technology. So energy policy, for instance, I think is going to be an important element of it. And then human resources and skilling. We are going to be in a world soon where we're going to need people who understand, who are trained on how to utilize artificial intelligence, not just how to build it, but how to utilize it. So I think all of those are areas of policy making that, yeah, more focus, more certainty will be helpful.
How much are you paying attention to the need for immigration, particularly high-skilled immigration, for Google right now at a time where there's some real questions around some changes in the immigration policy?
Look, Google is a company that was founded famously by people who had immigrated, or families had immigrated to the United States. We have long believed that to be the best technology company in the world, we have to be able to draw on the world's best talent. And that means being able to locate those people around the world and have them become part of our company. And sometimes that means bringing them into the United States. And so immigration policy, and particularly high-skilled immigration policy, has always been an area of focus for us. We continue to believe that it is going to be a key determinant of competitiveness, not just Google's, but frankly the United States' competitiveness going forward. So we do hope that this is an area that becomes, an area of greater consensus and policy making that will enable us to do what we need to do.
There's the issue of the personnel, and then there's the issue, and you mentioned this, of energy and how important it was to have the energy sufficient to power some of these data centers.
Yeah.
When you go around the world, how much are you scouting out energy sources as much as anything else?
Well, happily, I'm not in charge of our energy sector. But look, it's clear energy policy and energy availability is going to be an important determinant. We are very proud of the fact that the chips we design, the data centers that we build, are among the most energy efficient, and are going to continue to see improvement in that area. I think all of the technology that we've developed over the course of time, it's been remarkable to see how much more energy efficient they are. But there's no question that as you look at the growth in the need for compute, you are going to see more demand, and energy is a key piece of that, which is one of the reasons why solid policies in all of the markets we're operating in around the world is important.
So we talked about personnel, we talked about energy. There's another issue that a lot of people are talking about right now, and Google and other large tech companies have come under fire for monopolistic practices. And your CEO came out in a recent earnings call and said that if some of the sort of antitrust issues were to come to a fore, it would have unintended consequences on a larger scale. What are some of those unintended consequences?
Well, look, there are specific legal proceedings going on that I'm not going to comment on, but I think writ large, what we see, first of all, is an incredibly competitive, dynamic market, right? If you looked at what the world looked like in technology even 5 years ago compared to what it looks like today, you have different players than before, you have new products, you have new technology. So the first thing to bear in mind is that this is an extremely, dynamic space. I think the second thing that I would, and this is sort of in direct response to your question, is the reality is that a lot of the work that large technology companies are doing it's sort of an integrated whole. In other words, the incredible research and development work that we're doing that is creating not just cutting-edge AI, but quantum technology, and is frankly helping find cures to diseases that we didn't know existed, or finding great new energy sources or whatever. That capability depends upon having certain scale and certain size. So, these discussions are going to go on for a while. We're principally focused on just making sure that we continue to try and generate great products that are going to address some of these big challenges that people and humanity has.
So just quickly here, who do you think your biggest competitor is? Do you think it's Microsoft, or do you think it's Baidu?
I would say both are impressive players in our space. I do. I mean, to implicit in your question is sort of China's presence in the technology space. And look, what I would tell you is that they are great technology companies. They're impressive in terms of what they do. We are competing with them globally. We need to anticipate that that's going to be the state of play for some time to come.
Thank you so much for being with us today. I really appreciate it. I'm going to send it back to you, Avril.
Great stuff. Thanks, Lisa. Lisa Abramowicz in Lima, Peru. More ahead on the Asia trade. This is Bloomberg. This is the Asia trade, the latest from the corporate front. JD.com's US-listed shares fell as a 5% jump in quarterly revenue failed to overcome concerns about Chinese consumer sentiment. The results just beat estimates but came off a low base from a year ago. CEO Sandy Xu told analysts it will take time for the benefits of Chinese government stimulus to feed through. Hedge fund manager Michael Burry has further increased his exposure in Chinese stock Cyan Asset Management, boosted its holdings of Alibaba by almost 30% in the third quarter, at the same time also adding new bearish options that will provide downside protection.
Donald Trump says there's no room for Jamie Dimon in his new administration, after previously saying he may consider the JP Morgan CEO for Treasury Secretary. Dimon responded while speaking to us at the APAC CEO Summit in Peru.
First of all, I wish the president well, and thank you. That's a very nice note. But I just want to tell the president also, I haven't had a boss for 25 years. I'm not about ready to start.
But Dimon also told us he's expecting a deals boom under the second Trump presidency, with the new administration seen as more amenable to mergers.
Because they have the Senate, the House, and the presidency, they have far more ability to do things like that. I think last time around, President Trump had started by saying for every new regulation, 1 in, 2 out. And I think later on he said 1 in, 5 out. I think they're going to do some of that again. I think it will, the banking industry, whether you voted for Trump or Joe Biden, a lot of bankers, they're like dancing in the street because, they've had successive years and years of regulations, a lot of which stymied credit, and so and you could have kept the banks equally safe, but had them do more credit. And so, to just give you an example, the average bank in America, I think the number used to have $100 of deposits and $100 of loans, and now it's $100 of deposits and $65 of loans. And if that's what you want, if for some reason the regulators think they're geniuses and that's the best way to run the banking system, so be it. But I think they did a lot of things that ended in that answer, but they didn't know that was going to be the outcome. So, and I think you could talk to any industry, and they'll give you examples of regulations that could be reduced and make it easier for them to do business while keeping the country safe, while keeping the air clean, while making sure the EPA does its job, et cetera. So I applaud them. They should be looking at those things.
Do you think if there is, particularly in the banking sector, less regulation, that there will be an even steeper competition with banks getting back some of the business from private investment firms?
Probably, yeah. I mean, because if you look at, you're asking about private credit and private investment, which I'm not against, and it has grown very rapidly, and it's got pros and cons. I'm always in favor of competition, but part of the reason that they are dancing in the street, which they said publicly, they used to get mad at me, now they say, no, he's right, is half the capital. No social requirements, no AML, no BSA, no fiduciary, no reporting to the government, no insurance, no liquidity. Yeah, it's a huge disadvantage. So yeah, I think it'll make banks get back some of that business. I think it'll be more important to regional banks than to JP Morgan.
There's also a question, whether it's banking mergers and acquisitions or just more broadly, whether there's going to be a more amenable administration to tie-ups. Are you seeing from your conversations in the past 7 days with companies that they are looking to expand their M&A pipeline to start putting that together?
Yeah, so yeah, absolutely. I mean, a lot of M&A was stymied by the fact it's not just sometimes you can't get through the courts or something like that, but it takes 2 years. It takes 3 years. So make believe you're a bank, and we've seen this happen, and one of these deals actually took 3 years. It takes 3 years to get it done. So you've done a deal, it's binding, you haven't closed it, but now you've got to run the company. You can't get the synergies, you're going to be losing people. You want to start working in a common culture and common technology, you can't do it. So yeah, a lot of companies are looking at, will be looking much more aggressively at acquisitions and deployment of capital, and they should.
JP Morgan CEO Jamie Dimon speaking at the APAC CEO Summit. Let's take a look at how markets are shaping up. Of course, it's the focus on Powell's comments, how he doesn't see a need to rush to slash rates. Markets earlier in the week looked like they'd gotten ahead of themselves after the US CPI print, but keep in mind what we're seeing in jobless claims as well as the PPI and how it was a bit higher. In terms of the Nikkei futures, we're seeing potentially gains at the start of trade after 3 sessions of declines. Makes you wonder how much the weak yen is feeding into the export-related counters. Of course, it is approaching levels that last prompted intervention from Japanese authorities, keeping an eye as well potentially on these mega banks that might move after the guidance was boosted from Japan's lenders. Now, Asia-Pacific real estate could be set for a gradual pickup in investment demand in 2025, but Bloomberg Intelligence thinks office properties could remain challenging in most markets, with Tokyo's solid rental growth prospects making it the exception. Let's discuss the outlook for the sector and bring in William Beardmore-Gray, Senior Partner and Group Chair at Knight Frank. He joins us exclusively from Tokyo. William, great to have you with us. Let's start off looking at the big picture in the region. Are you seeing a recovery in the real estate sector?
Good morning. Look, property markets around the world are recovering slowly. We've seen conditions improving generally because, we've seen the end of the election cycle. We've seen the reduction of interest rates and the direction of travel for investors looking more positive. The bid-ask spread has been reducing, and as you rightly say, in the core markets around the world, there's a shortage of office accommodation, and occupier sentiment is up.
William, are you expecting any knock-on effects from the Trump presidency?
Well, look, I mean, I think the most important thing about the result in the US election is that uncertainty is now out of the way. And, the general feeling is that that result is going to be positive for business. And as I mentioned just now, with the conditions for investment looking more positive going forward, the emerging signs of early cycle investors coming back into the market, taking advantage of the opportunities that are out there, we see, yes, as positive.
So, William, you're on a sweep through some of Asia's major economies at the moment. You're obviously joining us from Japan today. What are the opportunities you're looking at there?
Well, I'm actually in Japan today to join a seminar with our partner SMTB, who we've been working with for 12 months. We're talking to 240 of their clients today about global market opportunities. Particularly if you're referencing Japan, look, it's a really interesting economy and location for investors. You've got low cost of borrowing. You have great tourism coming back into the market, opportunity for the hotel sector, and real interest from outside investors in both offices and living sectors.
I'm just wondering also, though, longer term, to what degree does demographics play a role in your forecasting and expectations, and all the way through the market, from residential through to office space, as the population declines?
Well, we think the outlook for Japan is solid, absolutely, and it is the market where, at the moment, one could call it the powerhouse of Asia. Demographics, as you say, though, is fundamentally important across all of the markets throughout Asia, and those safe haven markets where investors are particularly interested at the moment, whether that's Australia, Singapore, Japan, we've spoken about. We're seeing India, where I've just come from, actually, really rise up the interest scale. I mean, India itself is an extraordinary market. We saw more first-time voters in the recent election in India than we saw vote in the entirety of the US election, which is a staggering fact, but plays to the rising middle class across or rising affluence across many of the markets in Asia, which is going to drive them over the next 2 years.
And part of this is also because of waning interest in China. What is your sense of whether the stimulus blitz is working its way through the real estate market there?
Well, we haven't seen any immediate reaction, and I think we're unlikely to. But the Chinese government is going to be absolutely determined to turn things around. The conditions at the moment are really challenging. Rising vacancy rates and a lack of occupier demand. But look at the flip side of that. That will, as these markets continue, provide opportunity for core assets in good locations.
All right, William Beardmore-Gray, Group Chair at Knight Frank, thank you so much for joining us today. We've got more ahead on the Asia trade. This is Bloomberg. Let's take a look at how we're tracking here in Australia, 40 minutes into trading in the final day of the week. And we're reasonably positive right now compared to where we have been, better by 0.25%. Even the materials sector, which has taken a bit of a beating over the past few days, is also higher by about 1/3%. Elsewhere, we've got a very soft Aussie dollar, below 65 cents US, but perhaps a function of a very strong US dollar. Well, we've got shares of the Sydney-listed enterprise software company company Xero near record highs, off the pace a little bit today by about 0.5%, but on year, Xero shares up nearly 70%, and we've got revenues performing very strongly, jumping about 25% from a year earlier in the latest results. And joining us now is Xero CEO Sukhinder Singh Cassidy. Sukhinder, thanks so much for joining us today. A pretty good set of numbers for the half there. You've got healthy cash flow, liquidity's looking good as well, shares hovering near a record. But I guess one of the key questions that stands out is when are you going to reward shareholders with a dividend?
Well, thank you. We're very pleased with the results in the half. Obviously, revenue growth up 25%, EBITDA up 52%, a rule of 40, 43. 0.9. And I would say I don't think we are a dividend story. I think we are a growth story. And our most important opportunity is to keep allocating capital to the best shareholder return, which we continue to believe is driving profitable growth.
Well, let's talk about the growth story then. Where do you see the demand outlook coming from? Where's the strongest growth going to be in the second half?
Well, I think, first of all, remember that we participate in a sector that globally still has low cloud penetration, and that's small businesses digitizing their accounting services and their sort of CFO software stack, if you will, even though they're all, independent owners of businesses. So when you look at that sector, the first growth comes from just the market TAM, which is as countries continue to push digitization. The UK, for example, has legislation called Making Tax Digital. You continue to see SMBs moving from kind of the shoebox into the cloud to help make their own workflows more efficient and their finances efficient. So that's the biggest tailwind in our business. I think if you think about where else demand comes from, well, we have markets that are at different rates of cloud penetration. So in a market like Australia, where cloud penetration is high, it comes from new businesses that are forming for whom now cloud native software is the norm, whereas in the US and the UK, two of our other big markets, that's not yet the case. But we do see really nice tailwinds, as we talked about, including from regulators to help SMBs come online with their finances.
Yeah, you mentioned the UK there. I mean, it's a small part of your business, relatively speaking, but the economy itself much, much larger than Australia and New Zealand, where you conduct a lot of your business. So what's the plans to grow your market share in the UK?
Well, first of all, the UK, as you point out, is our second biggest market worldwide. Actually, it's one of our key growers. And if you think about the real impetus there, it's for digitization of taxes led by the government in a program called Making Tax Digital. This is phase 3 of that government program. So SMBs have been coming online over the last many years with their finances and their accounting, and we have been real, I think, leaders in that sector. We also, in that market, see servicing the accountant and bookkeeping channel, which is a very big way small businesses get their services provided in a market like the UK, helping those practices digitize as accounting and bookkeeping firms themselves consolidate and roll up to private equity. Digitization of that key channel is another driver of our growth.
What about in North America? I mean, revenue growth strong, but I think subscriptions fell. Are you perhaps expecting a boost from a pro-business Trump?
I think we actually, our outlook for North America is relatively independent of administration. It's really much more led by small business need. And as you pointed out, there's still a massive TAM in the US because cloud penetration of digital native solutions for accounting is still relatively low. And of course, it's the world's largest SMB market. So look, we're actually pleased with our progress in the first half. We're making a lot of efforts to keep driving and accelerating our product features and functionality for the US, which is a really critical market for us, announcing new features like embedded bill pay. Just announced yesterday a deal with Gusto to embed payroll in our offering. And then innovating in areas like AI with our AI assistant Jax in analytics, where we announced an acquisition in the half of Sift Analytics. So we have a lot of features and functionality that we're building for the US and globally, and continue to be excited about that market and our opportunity there.
Sukhinder, as you highlighted earlier, you work very closely with small businesses. They've also been, for the past couple of years, dealing with higher costs. What are you hearing in terms of, potential financial stress? What are the concerns for these businesses?
Well, first of all, it's interesting. We run our own panel called Xero Small Business Index in every market which we participate around the world. So we do, in fact, measure what's going on with small businesses. And I think mostly what we see that is market agnostic is late payments continue to be a big cash flow issue for small businesses. And that is sort of continues to be, I'd say, a problem, particularly when you think about the people who are late paying small businesses well, they're big businesses. So in the UK, as an example, we have legislation from the government around visibility on late payments to small businesses. So that seems to be pretty enduring. And then different markets have different conditions. I'd say different rates of unemployment, though still unemployment is relatively low in most of our markets. And we do still see new business formations in the positive territory in all of our markets.
All right, Sukhinder, great to have you with us. Thanks for taking the time to chat. Sukhinder Singh, Cassidy, CEO at Xero. And the latest from the corporate front, ASML surged in Amsterdam after the chip equipment giant retained its bullish long-term revenue outlook. It's projecting sales of up to $63 billion by 2030, citing growing AI demand. ASML is seeking to reassure investors after its order intake significantly missed analyst estimates in the third quarter and sparked a sell-off in its shares. NVIDIA's Taiwan hardware partners Shanghai and Quanta Computer are forecasting the boom in AI server demand will continue into 2025. The companies reported earnings that beat expectations thanks to a global rollout of AI data centers. Shanghai says it expects AI sales to make up 50% of its server business in 2025. The U.S. Federal Trade Commission is reportedly set to investigate anti-competitive practices at Microsoft's cloud computing business. The FT says the regulator is looking into allegations that Microsoft is blocking customers from moving data from its Azure cloud service to rivals' platforms. The report says tactics include exit fees and punitive licensing terms. More ahead on the Asia trade, this is Bloomberg. Some breaking numbers crossing the terminal. We have Japan's latest GDP print for the third quarter on a seasonally adjusted on-quarter basis. We're looking at the number at 0.9%. This is a faster pace than consensus that expected 0.7%. But looking at the prior quarter, actually how it was revised downwards to 2.2%, we are, of course, seeing this slower growth, but some have already been flagging that this can potentially be attributed to one-off factors, including some bad weather in Japan and the government's alert on the mega quake. So something to keep in mind. Private consumption also expected to actually show its way through Japanese growth, and certainly given the faster than expected print, that might have figured into the equation. Paul.
Well, Japan's biggest banks have raised their annual profit forecasts and unveiled plans to buy back shares, reaping the rewards from rising interest rates. Asia investing editor Russell Ward joins us now from Tokyo. So, Russell, what were your top takeaways from the earnings?
Morning, Paul. Yeah, pretty stunning set of earnings from all three banks. We saw all banks' profit growth increase, and we saw them all announce buybacks, as you mentioned, and raise their profit forecasts to fresh records. So this is all after the banks have been benefiting from rising interest rates here in Japan. Of course, this is the first full year where they're operating in an environment where the Bank of Japan has hiked interest rates, and also they're benefiting from selling their cross shareholdings. This is part of the corporate governance reforms in Japan to sell these shareholdings, and they're doing that at a time when the stock market is buoyant. So they're booking healthy gains on those, and that's translated into bumper profits that they're sharing with their shareholders.
So were the buybacks a surprise to you?
In the case of Mitsubishi UFJ and Sumitomo Mitsui, not so much, although MUFG's buyback was a bit bigger than some analysts had anticipated. But the big surprise came with Mizuho. No one was really anticipating Mizuho buying back shares at this point. In fact, it was their first buyback since 2008. The bank has spent many years replenishing capital, investing in its business, and it hasn't quite had the same leeway or buffer that its two rivals had to buy back shares. But now it's pulled the trigger. The profits are obviously so good that the management has decided to buy back shares now. So we'll just have to see how the market reacts to that when the shares start trading in a few minutes.
Russell, what are the risks for the banks going forward from here, though?
Yeah, it's interesting, actually. The CEOs were quizzed at the press briefings on what their impressions are of the President-elect Trump's next administration. And they sort of said that, that there's going to be some positives from that. An uptick in deal making, things like that, but also perhaps an uptick in inflation, which would have cut both ways for the banks. Actually, it could be quite beneficial, the prospect of global rates being higher for longer, and banks could reap benefits from that. But of course, no one likes sticky inflation for too long. So those are some of the risks that they pointed to. Another one, of course, is the risk of another trade war.
Bloomberg Asia investing editor in Tokyo. Thanks so much, Russell Ward, for us there. Now let's recap what we got out of Japan's GDP numbers a couple of minutes ago. We got a better than expected print for the third quarter at 0.9% growth out of Japan. And this is, of course, on an annualized basis, but it is a step down from the revised 2.2% for the second quarter. And there are some temporary or one-off factors at play here. You think back to how Japan was dealing with bad weather at that time. The government had also issued an alert on the megaquake, so that is seen as something that might have subdued activity. And essentially what we're hearing from some of the analysts is that that's not going to be a hindrance for the BOJ in terms of future rate hikes. And you think as well on what we're seeing on dollar yen as it keeps climbing, we are seeing how that is exerting some pressure, inflationary impulses. Remember, import inflation is a key factor. Arguably, that's something that prompted the BOJ's surprise move in July. Markets open in Seoul and Tokyo next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens. Of course, Paul, the focus for markets has really been those comments from Powell talking about how strong the U.S. economy is, and data really backing that up, whether you're looking at the U.S. PPI or some of these jobless claims that came in as well, Paul.
Definitely, we've seen yields on the 2-year rising, dollar strength continuing to be a theme as well, but geopolitics looming large also, because we've got Xi Jinping just making his arrival in Peru for the APAC conference, and he'll be on his way to take part in the inauguration of a new port in Peru, Avril.
Certainly, and of course, at the back of everyone's minds is going to be about the tariffs, Trump's policies, what sort of agenda in terms of whether it's going to move past rhetoric into actual implementation. That's really what's prompted the risk-off in the markets in the past week or so since Trump's win. Today, we're seeing a reversal in the Nikkei's fate. I mean, 3 sessions of declines, but 0.7% gain at the start of trading. It is broad-based, it looks like, as the topics is following suit. And of course, this is against the backdrop of that GDP print coming out from Japan on the third quarter. We saw a revised downwards for the second quarter, and the third quarter was better than expected. But I think the sense you get is that overall, it's not going to prompt a change in the BOJ's path towards normalization. Of course, a lot of the focus is going to be on the mega banks, given how they upgraded the guidance yen. So the outlook looking really good for Japanese lenders as rates climb. Keeping a close watch on dollar yen as well, hovering at 156.5 at the moment. Of course, this is against the backdrop of the US dollar just been marching ever higher, and it's closing in on levels that have actually prompted intervention this year from Japanese authorities. Let's take a look at how Korean markets are shaping up, because they have also been part of that very bearish sentiment on Asia stocks today, extending those declines 1/3% lower. The tech gauge, the KOSDAQ, seeing steeper declines, perhaps part of that narrative of caution among investors. Dollar won sitting at 14.06. Paul?
Let's take a look at how we're doing here in Australia. Meanwhile, we've been up and running on the ASX for about an hour now, and we're seeing a modestly risk-on session. We're 0.4% in positive territory, and even the materials sector, which has been having a rough ride this week, is also higher as well by 1/3%. So almost every sector in positive territory in Australia at the moment. Elsewhere, we have seen yields on the 2-year ticking up. We've got a somewhat weak Aussie dollar as well, and we did hear remarks from Jay Powell earlier also. On the back of that strong US data, Powell did note the strength of the US economy, and he also said, look, if the data lets us go slower, seems like the right thing to do. Let's have a listen.
The economy is not sending any signals that we need to be in a hurry to lower rates. The strength we're currently seeing in the economy gives us the ability to approach our decisions carefully. Ultimately, the path of the policy rate will depend on how the incoming data and the economic outlook evolve.
Well, our next guest sees US interest rates on hold for longer, with a potential short-term inflation uptick under President Trump. Joining us now is Anthony Doyle, Head of Investment Strategy at Firetrail Investments right here in Sydney. Anthony, thanks for joining us. A number of people interpreted those remarks from Jay Powell as somewhat hawkish. We have a chart here on the Bloomberg as well that illustrates, well, there's now less than 25 basis points of tightening being priced in for the next 2 meetings. So are we higher for longer now?
Yeah, undoubtedly. We're removing that risk aversion event, which was the election, and having some certainty around that has set off animal spirits in risk assets in particular. And that has had implications as well. Some of the policies that may or may not be enacted has had implications for inflation expectations. But undoubtedly, the US economy is performing a lot better than many had anticipated. Certainly at the beginning of the year, with economists putting a 50% likelihood of recession in the next 12 months. So the price action that we're seeing in risk assets, but also bond markets, reflect the stronger US economy, US exceptionalism. And the comments coming from Jay Powell last night reiterate they are data dependent. There isn't a preconceived policy path. They are restrictive at the moment, and lower inflation does enable them to cut interest rates.
Is the scene getting set here for a showdown between Jay Powell and President Trump in 2025? I mean, and Jay Powell's already said well in advance he's not going anywhere. What are the risks around this?
Yeah, I think so. Jay Powell will ultimately aim to defend the Fed's independence, and Trump understandably loves lower interest rates. So it's a bit of an interesting conundrum that we have here and it exists in many nations around the world, between fiscal and monetary. Fiscal remains highly stimulatory. Governments around the world, particularly the US government, haven't really reined in on some of those stimulatory fiscal packages. And with Trump, arguably, we're going to see another Keynesian fiscal stimulus, leaving monetary policy and rates as the only game in town to try and keep inflation in the bottle. So certainly, I think Jay Powell, the Fed, they are an independent central bank. The worst thing would be if they lose some of that independence. And he will continue to manage expectations in the marketplace around the future policy path of rates.
Anthony, I mean, against the backdrop of, really that digestion of the results, I think some are also breathing a sigh of relief that at least it was decisive. Republicans have the trifecta. What is your sense of what this means for policy implementation, and perhaps if we do indeed see a rally into the end of the year?
I don't think there's anything in the immediate future that will derail the rally in risk assets. Potentially, if you did see stickier inflation or really strong payrolls, unemployment rate numbers, that could measure or reduce the market's expectations for lower rates. I do expect a rate cut in December before the Fed pauses in January. Now, looking through history, it is extremely difficult to try and front-run policy, government policy, and we have seen the markets try and ultimately pick who the winners and losers will be. But if you cast your mind back to Trump's last presidency, oil and energy stocks actually underperformed in that environment, and under the Biden administration, oil and energy have outperformed, while clean energy has derated materially. So it is difficult to front-run policy expectations. Markets will try and do that, but ultimately it will be fundamentals and company fundamentals which will determine the outlook for equity markets.
Yeah, that's a really interesting dynamic that you highlight between the rhetoric and what is actually being witnessed in the markets. But I also wanted to get your thoughts on this disconnect that we saw earlier in the week between the dollar and short-term treasuries after the US CPI print. Do you think this is something that we're going to see more of going into next year, just asset classes looking a bit disjointed?
Yeah, certainly correlations have begun to move in unusual ways, and a strong dollar is something that Trump isn't particularly in favour of either. And arguably it reflects some risk aversion that you're seeing in currency markets as well. But more ultimately, as I mentioned, the future path of policy is likely to have interest rates higher for longer. And as a result, currencies, and US dollar in particular, has found a bid as a result of stronger growth, stronger consumption, and higher interest rate expectations. With only 2 months ago, 150 basis points of rate cuts expected from the Fed in 2025, that's now around 70 basis points. So a big move in rate cut expectations from the bond market.
In terms of the US dollar, we're seeing some impressive momentum behind the dollar spot index at the moment. How unappealing is this making emerging Asia at the moment? We've got some pretty reasonable valuation, especially if you look at somewhere like Korea. But is this just a non-starter at the moment?
You're quite right, Paul. It is difficult for EM assets to rally in an environment where the dollar is rallying. Typically what you want to see, and the past relationship has been, weaker dollar, stronger EM assets. So it does put EM assets, equities, bonds under pressure in the immediate future. Some of the big moves may potentially be in the developed markets, particularly for the yen, as it looks like the Bank of Japan will continue to raise interest rates. Those interest rate differentials come into play, the carry trade. That might see the yen actually as the star performer over the course of the next 12 months versus USD.
Yeah, so obviously there's a favourable climate here for US assets at the moment, but in terms of second-order consequences from a potential trade war, is it possible to predict where we might be going from here?
It's so difficult, isn't it? Particularly with China. China does face the 3 Ds of demographics, deflation and deleveraging. And there hasn't been a huge impetus from the Chinese authorities to enact the type of stimulus package that we saw post-GFC, and for good reason as well, I think. China has increasingly found itself up against growth challenges as it has faced that Lewis turning point where rural workers, the supply has come under pressure and is gradually being reduced, so wages are beginning to increase as well. So there are second order and third order effects from this. We are seeing the reshoring of supply chains post-COVID. That is likely to continue. Certainly some of the EM regions that stand to benefit include Mexico, absent any sort of trade war with the US, but there are regions in Southeast Asia as well, like Vietnam, for example, that could potentially benefit from those reshoring of supply chains.
Well, Anthony, they've kind of done it before, so let's hope the second time might be a bit easier. Anthony Doyle, thanks so much, Head of Investment Strategy at Firetrail Investments. Let's check in on how some of these markets are moving. Of course, paying close attention to the Japanese lenders after they raised their profit goals. We're seeing a very positive start to the trading session. Of course, some of these lenders, Mitsubishi UFJ Financial Group, for example, are heavy heavy components on the topic. So you might see a bit of a broad-based lift to stock markets in the country. Mizuho's share buyback was a bit of a surprise, so you can see why it is outperforming versus its other lending peers. Financial stocks in general are doing well today. Paul?
Let's check in on how Nissan is tracking. The the automaker sees its shares rising by about 4.5% at the moment. This is on the news that activist investor Oasis Management now holds a minority stake in Nissan. So the Hong Kong-based investor has been holding that car maker for even longer than Efficimo Capital Management, which is another activist shareholder which has been taking a position. So we did see Nissan shares surge earlier this week when it was revealed that Efficimo held a 2.5% stake in the automaker. So a lot of interesting positioning going on in this stock. Bit of breathing room for Nissan, though. It's got 1 year before it hits a record bond maturity wall in 2025, and there are obviously concerns about its ability to generate cash. But shares right now are firmly in positive territory in Japan. We have more ahead on the Asia trade. This is Bloomberg. Let's check in on some of the automakers now, particularly those who have an interest in manufacturing electric vehicles. We're seeing them all moving lower at the moment, including Tesla off by 5%, Rivian off by more than 14% now. All right, this is on reports that President-elect Donald Trump plans to eliminate the $7,500 tax credit for electric vehicles. So that would potentially deal a significant blow to EV adoption in the US. Now, you might ask yourself, why would Tesla support such a move? And of course, Elon Musk is part of President-elect Trump's inner circle. Well, Elon Musk has said, well, he thinks his company is better positioned to deal with the potential pullback of incentives. Perhaps for his competition, not so much. Musk did post on Thursday on X that the US should end all government subsidies, not just for EVs, but also oil and gas as well. JP Morgan CEO Jamie Dimon says he's not bothered by Donald Trump saying there's no room for him in his cabinet. Speaking with us at the APAC CEO Summit in Peru, Dimon says he didn't want a government job anyway, and he sees the next administration facing a very tall order.
You had a big sea change that took place in that vote the other day, and some people were prepared and some weren't prepared. But I think the most important thing is whoever had been elected, and this is my belief, they are entering and going to be responsible for the most complicated geopolitical, military, and geoeconomic situation that the world has faced since World War II. And of course, I wish them all the best. I think people try to help get through this. It could be a difficult thing with a lot of unknowns and uncertainties. And so policy is going to matter. And of course, who runs the government will be determinative there.
President-elect Donald Trump sends a message to you that he respects you greatly, but you will not be part of the Trump administration as a Treasury Secretary, if that were something that were interesting to you.
First of all, I wish the president well, and thank you. That's a very nice note. But I just want to tell the president also, I haven't had a boss for 25 years, and I'm not about ready to start.
I want to start by also talking about the response in markets in the U.S., which has very much been, this is going to be a pro-growth shock with companies that are going to be investing much more, deploying cash, aggressive in terms of U.S. expansion. Have you seen any signs that that's truly the case?
Well, yeah, you've already seen, the markets have responded quite well. And, I think America needs a growth strategy, so I literally applaud that. I think collaboration between government and business is the way to have growth. They've already spoken about a deregulatory environment. I want to point out, I'm not talking about just getting rid of regulations, but the regulatory environment in most countries has become stifling. And in a lot of countries, including Peru, it's why you're growing maybe at 2.5%, not 4 or 5. In America, it's why we've been growing at 2% for 20 years and maybe not 3. So I do think it's a reasonable thing to have that kind of reform. And that reform has to go deeper than just regulations, which can unleash capital and investment and banking and stuff like that. It's got to be permitting and all the related things that come with that, where people, you just mentioned me a mine that, someone bought that could do rare earths in the United States. It's 10 years. They haven't gotten their permits yet. I mean, it's a shame, and we're doing this to ourselves, and it's a mistake. So I applaud any government that says, I'm going to make government more efficient. And I think inefficient government is one of the reasons that people are frustrated. That why you have some populism, because they may blame, they may look at big companies, but they also know their government isn't spending their money wisely.
JP Morgan CEO Jamie Dimon speaking with Bloomberg's Lisa Abramowicz at the APAC CEO Summit. Of course, we don't have a clear sense yet who Trump has in mind for a Treasury Secretary, but we do have the latest report from the Treasury. Of course, this is related to foreign exchange practices. This is going to be the last one that we get from the outgoing Biden administration, and it has put South Korea on the foreign exchange monitoring watch list. We're seeing the Korean won looking a bit softer today against that backdrop. We also heard from the report and how the Treasury Department concluded that no major U.S. trading partner manipulated the rate of exchange between its currency and the U.S. dollar. And the last time that the Treasury actually designated a country as a manipulator was in 2019. That was under President Trump at the time. More ahead on the Asia trade, this is Bloomberg.
Let's take a look at how we're tracking in the commodity space at the moment. Been losing a little bit of ground here over the past little while, but iron ore prices, for example, now below $100 a ton. Crude prices are recovering, but they've been dropping as well. The IEA expecting a surplus next year as demand growth in China slows and output increases, but it's really a strong US dollar that's also been helping to force these commodity prices down. Just as a case study, for example, here in Australia, the Fortescue Metals Group, which is a pure play iron ore stock, that's slid almost 6% since the US election. However, Fortescue also has as part of its house Fortescue Future Industries, and Fortescue Executive Chairman Andrew Forrest says the energy transition is an economic opportunity. Speaking to us at the COP29 climate conference in Azerbaijan, Forrest gave us his view on progress in carbon emission reductions since the previous meeting.
It's been all politics and not economics, which has slowed it up. I think if we could just call it for what it is, which is an energy transition no longer, because there's so much concern about that, which has been laced into the human psyche across the world by the fossil fuel sector. Let's actually cut to the chase to what it actually is. This is an economic opportunity transition.
They've been calling it a financing summit. I mean, are you optimistic that we're going to get to a point where developing nations get the funding that is required to aid them with the transition?
Yeah, I actually am, but not for the direction we're on. Net zero, if anyone's tried to finance it, and I offer this to anyone who's trying to develop a green energy project throughout Africa, throughout the Middle East, Fortescue's there to help you, because we will put on the table what bankers want. We'll put on the table what investors want. No one knows what net is. Is it carbon sequestration? Well, that's proven not to work. Is it carbon trading? Is it offsets? Or is it some other language which is going to get introduced between now and 2050 to suit some company?
Yeah.
No one knows. But real zero, where you just obliged to stop burning fossil fuel by a date, you can finance that. It's a hard number. This is what it will cost you to build your full replacement of fossil fuel. You can amortize that against the huge margin of this is what you'll save when you stop buying any fossil fuel, diesel, oil, gas, you name it. That margin is a hard number each year. You can finance that. That's real zero.
What happens if, to use your term, the new CEO, the chief executive of the United States, the new president comes in and pulls the U.S. out of the Paris Accords? What happens to all of these climate efforts?
Well, I don't think anything happens. This is an economic transition. In Paris or not in Paris, I can just say that president-elect is a business person. He can see that if you invest and trigger all the policies to really get fossil fuel cranked up, for new investment, forget about maintenance of these old rust buckets, these new investments, you're going to get to a total of around 600 billion over his term. If you go renewable with all the policies in place, you're going to get new investment about 1.6 to 1.65 trillion. There's $1 trillion margin you're going to withhold from the American people. Hey, let's just do the numbers, right? He's going to follow the money. He's a pragmatic president. If the president of the United States thinks, well, drill, baby, drill, he's just forgetting that that's 200 years old. Look where it's got us all. A very volatile energy price, an uncertain energy future, erratic standard of living because we've got an erratic cost of energy. Let's go build, baby, build. Let's build out these renewable energy systems. Let's give the American people the lowest cost of energy. Let's give companies who invest in it high margins. Let's not stand in the road of that future.
Fortescue Executive Chairman Andrew Forrest speaking to our colleague Jumana Basecci. Now, the latest corporate stories we're following, ASML surged in Amsterdam after the chip equipment giant retained its bullish long-term revenue outlook. It's projecting sales of up to $63 billion by 2030, citing growing AI demand. ASML is seeking to reassure investors after its order intake significantly missed analyst estimates in the third quarter and sparked a sell-off in its shares. NVIDIA's Taiwan hardware partners Shanghai and Quanta Computer are forecasting the boom in AI server demand will continue into 2025. The companies reported earnings that beat expectations thanks to a global rollout of AI data centers. Shanghai says it expects AI sales to make up 50% of its server business in 2025. The U.S. Federal Trade Commission is reportedly set to investigate anti-competitive practices at Microsoft's cloud computing business. The FT says the regulator is looking into allegations Microsoft is blocking customers from moving data from its Azure cloud service to rivals' platforms. The report says tactics include exit fees and punitive licensing terms. More ahead on the Asia trade, this is Bloomberg.
Here's how we're doing in Asia markets this Friday morning in the Asia Pacific. Bit of a mixed bag. We're modestly positive here in Australia by 0.5%. Even the materials sector, which has had a rough ride over the past week, is recovering. The Nikkei, meanwhile, powering ahead, better by 1.4%. We've got a very weak yen, 156.64 right now. Kospi in negative territory, though, by 0.2%. We did hear earlier that Korea's been added to a monitoring list by US Treasury for Forex practices, and probably not good news on the trade front either with the incoming Trump administration. Korea does run a current account surplus and a bilateral surplus with the United States as well. Kospi down 0.2% right now. Avril.
Yeah, Paul, and of course we saw how Citigroup downgraded those Korea stocks to underweight from neutral, as you alluded to there. But shifting gears and taking a look at what we're seeing among some of these big bets from investors, Alibaba, among the shares that hedge fund manager Michael Burry has added to the China portfolio at Cyan Asset Management. Let's get more on that and other highlights in 13F filings with Bloomberg Global Markets reporter Yes. So we are seeing how Burry has added to those China bets, but he's also provided some downside protection. What's your sense of his strategy here?
Yeah, it seems, thanks for having me. Yes, as my colleague Yi Ching and I reported for Bloomberg, according to the 13F filings, Michael Burry actually boosted his holdings of three large Chinese companies, including JD.com, Baidu, Alibaba. But at the same time, what's interesting is he added a lot of put options to his portfolio, basically covered the majority of his holdings. The idea is that he tried to get the upside with his equity holdings, but at the same time to provide some hedges in case this rally fizzled. So he could limit his losses or can lock in a profit for him.
Are there some risks to this strategy, though, after President Trump is sworn in January?
Definitely. We already see a majority of the Chinese rally has kind of wiped out, especially in the overseas listed Chinese companies. In fact, Baidu, JD, and Alibaba all back to the level before the Chinese pivot in late September. So it's a reasonable guess. He probably already, the put option has already hit their strike prices. He could potentially out of the market as well.
Yes, yeah, thank you so much for providing insights. Really interesting what he's chosen to do here with Chinese stocks at a time when certainly there's a bit of caution in the markets, given how the stimulus just hasn't been as forthcoming. Bloomberg Markets reported yes, yeah, there. Now, JD.com's US-listed shares have fallen as a 5% jump in quarterly revenue failed to overcome concerns about Chinese consumer sentiment. Bloomberg Intelligence senior analyst Catherine Lim joins me now. So, Catherine, looking at JD, what are your key takeaways from the scorecard?
Right. We've seen an acceleration in the revenue growth for the retail side in the third quarter, which is the July, August, and September quarter. But I guess the real concern is this current quarter, the Singles Day quarter itself, will they be able to actually upkeep that momentum? And notwithstanding, Avril, we've actually talked about it, the lengthier Singles Day, lots of promotion out there. Are they in a position to continue to actually uphold their retail margins in this current quarter? And I think that's the big question mark, and we'll have to see what Alibaba says today.
But it looks pretty promising now, right?
It is. It is. And I think that, if based on what JD.com has reported so far, Alibaba's third quarter number, or rather their physical second quarter number itself, shouldn't quite be too bad. But again, the real question is this current quarter. What's the indication for the GMV growth, for Singles Day, etc.? Worth noting, though, that JD.com did not provide any numbers to the GMV growth last night. Yes, order volumes were up, users were up, but they've actually stayed away from guiding on what was the overall revenues growth from the Singles Day.
So we're going to have to wait a while till we actually get details. But to your sense of how, we've seen that September stimulus blitz really lifting confidence among consumers. But of late, there's been a fair bit of disappointment as well.
Right.
So what is your sense of consumer confidence in China?
I guess, Avril, I'll look at it this way. Yes, market sentiment, has on the rise on the back of the stimulus that has come through. But the reality is that for that to actually flow down to spending and then the real consumer confidence, etc., it's going to take a little while for that to actually materialize. And notwithstanding, I think you've actually also mentioned earlier on the show itself, we've got tariffs, the risk of tariffs looming for the entire economy. So we'll have to actually really see what happens over the next 6 to 12 months on that front.
Yeah, I think there's a bit of skittishness against that backdrop. Yeah. Thanks so much, Catherine, Bloomberg Intelligence Senior Analyst for Consumer and Technology in Asia, Catherine Lim. Now, as Kat was mentioning, it's really about those tariffs. So let's bring in Wang Tao, Head of Asia Economics and China Economist, Chief China Economist at UBS Investment Bank. So Wang Tao, you have a bit of a roadmap in mind as to Trump's enacting of tariffs. What is your sense of the timeline as well as the impact that's going to likely be seen in China?
Right. Thanks for having me. Well, nobody really knows how things will be done when Trump is sworn to presidency. We looked at the previous experience and looked at potential administrative challenges and so on. So we have made a baseline assumption. Well, the Trump administration could announce the tariff hike on China quite early next year, but the actual implementation starts in the third quarter next year. So we have basically a 6% tariff hike on the first batch of goods, about a quarter of U.S. imports from China in September. And then the second batch coming in January 26th, A third batch will come in March and June, all 60%, but the March-June is 30% each time. And the final batch will not be applied because they probably have a bigger impact on U.S. inflation and so on. So that's our baseline. Obviously, there's quite a bit of uncertainty around that, but we think the impact on China in terms of exports decline, most of that will happen in 2026. But the Chinese corporate, in terms of their capex spending, their recruitment plans will already start to take effect in 2025. That's why we are looking for the government to intensify stimulus next year to try to offset some of the impact.
Given that, I mean, your base case is for the stepped approach to tariffs, what is your sense of whether businesses will have enough time to realign supply chains?
Well, so the businesses have already been shifting some of their supply chains abroad since last time. And our CFO survey have shown that about 70% of the businesses that exports out of China have some kind of production overseas. And no doubtly, they will continue to intensify that process. But some production are going to be difficult to shift outside of China. But also, even with that shift, maybe the companies can continue to produce and export from somewhere else. But that does mean job losses and investment losses in China still. That's why I think it's the impact, the tariff hike will have significant impact on China's exports and overall economy.
Now, I know you see a staged introduction of tariffs. Do you have a sense of which sectors and which products could be targeted first? And are there some products from China that could potentially be left alone?
Yes, indeed. We think that they will start with imports from China that are potentially some capital goods components that they can more easily source from elsewhere in the world. And there will be a bunch of products that are consumer goods that has, for example, 60, 70, 80% of U.S. imports are from China. That makes it very difficult to source elsewhere, and that potentially have a more impact on U.S. inflation. Those could be left alone, including some consumer electronics, for example.
In terms of the consumer, meanwhile, I mean, we do have retail sales coming up for October as well. We do anticipate some improvement there, but to what degree are seasonal factors at play, and how sustainable do you see any recovery being in consumer sentiment in China?
Right. Well, the government has started to push out this home appliances trade-in program since August. And so we have already seen improvement in retail sales in September, and October will continue to showcase that. So we do see retail sales rebounding. And of course, since the end of September, there has been a pivot in policy. So far, we have only seen major announcement in the local government debt restructuring. We have seen support to the property market. To the extent these measures can help stabilize the property market sooner rather than later, that will help boost consumer confidence. We do expect going forward, the authorities will probably expand the trade-in program and also increase subsidies to the household sector next year, especially on the low-income people, unemployed, and also measures to try to boost childbirth for multi-children homes as well. So there has already been signs of that coming through. So we do think that in the fourth quarter of this year, this current quarter, retail sales will improve, property sales will become less negative, infrastructure investment will be supported. So overall, we're looking for fourth quarter GDP growth to rebound to 6+% on a Q-on-Q basis. So that will help this year's growth getting close to 5%.
And of course, the incoming readings will give us a sense of the base that China is going to be working with in dealing with Trump's tariffs. What is your, sense of whether Chinese authorities, the extent in which they're going to be using the Chinese renminbi weakness as a bit of a buffer against that?
Right. I think that the renminbi, of course, will face depreciation pressure. It has already depreciated a little bit, mainly because the dollar has strengthened so much against other major currencies. From the basket point of view, the RMB has not really moved in the last few weeks. Next year, we continue to see RMB weakness, but not as a proactive policy tool in response to tariff hike, but more as a way to tolerate some depreciation because of the market pressure, because of the weakness on the export side. I think the authorities will really focus on putting in more fiscal stimulus, more monetary easing to help boost the domestic demand. That's the main way to try to offset the external shock. So we are looking for an extra 3 trillion RMB of fiscal spending next year. We're looking for 50 basis point of extra rate cut. And also, we are looking for more property support measures, including about $1 trillion a year in destocking program. So various measures on the domestic front will be the key. And exchange rate will be only depreciating very modestly, about 5% or so.
All right, Wang Tao, head of Asia Economics and chief China economist at UBS Investment Bank. Thanks so much for joining us. Now, a unique public stock forum is having a revival in China's financial capital. The daily outdoor gathering of retail investors disappeared during COVID. But as Stephen Engel reports, crowds are swelling rapidly again, spurred on by government stimulus.
On this otherwise quiet, leafy Shanghai street corner, many opinions, from the stock market to even the next man in the White House, can get quite vocal.
The market right now is so good. Look at how popular it is here.
He's talking about the so-called stock salon, an informal outside gathering of hundreds of mom and pop stock enthusiasts, everyone from so-called market gurus dishing advice to punters playing off the latest rumors, including the highly anticipated fiscal stimulus from the Chinese government. No wonder some call the Chinese stock markets a bit of a casino.
The stock market is a place with the most rumors. If you buy stocks based on rumors and sell based on rumors, you'll never make money. Believe in yourself and own your destiny. Don't trust others.
China's stock markets are, after all, dominated by an army of some 200 million retail investors. The street corner salon emerged more than 30 years ago when China set up its securities exchanges. But it went quiet after a market meltdown in 2015, moved online, and then went dead during the COVID lockdowns of 2022. But now, with a recovery in stocks since China unleashed stimulus in late September, the live salon has come roaring back to life, along with perhaps a lot of hopeful exuberance.
I think the bull market will last for 5 years or even longer because we have more than 300 trillion in deposits. The government won't let you keep the money in banks. It will be a burden on the banks and it will be a drag of economic growth as people no longer consume. Now, everyone is relatively conservative since the pandemic.
Conservative with spending, perhaps, but many here did not hold back when it came to Trump and tariffs.
Let me tell you about the tariff. I can assure you that it won't be high. He's just saying that. He's a businessman. He will change his approach for profits.
These are short-term fluctuations. He may increase tariffs, but increasing tariffs will actually hurt the U.S. more. The U.S. still relatively relies on China.
Large unofficial crowds like this one in Shanghai can make authorities a bit nervous in China, hence the fairly large police presence. I've seen a number of officers kind of surf through the crowd looking for who knows what among the mostly male stock-picking punters. I even had a car pull up, the windows rolled down, two guys dressed head to toe in black, big smiles saying, "You want to make money, money, money?" Of course, I passed them up on their offer, but still, another couple got out of a Rolls Royce and went into the crowd. I guess everybody in this city of business is looking for a good stock tip or two. Stephen Engel, Bloomberg News, on a street corner in Shanghai.
So interesting to see retail investors taking the streets in Shanghai. We have more ahead on the Asia trade. This is Bloomberg. So you get the sense that it might struggle to get to 158 in the near term with that in mind. Meantime, Japan's economic growth slowed in the third quarter, boosting the case for the government stimulus package to be unveiled later this month. Bloomberg economy and government editor Paul Jackson joins us now. So, Paul, given that there was a bit of an upside surprise to the latest print, does this back the case for the BOJ in terms of rate hikes?
Yeah, I think today's result is very much favourable for the Bank of Japan. You could say it's a better result for the central bank than it was for the government. We've seen consumption, private spending increase despite all the inflation woes that have been weighing on the public. That's for the second straight quarter. So that's kind of evidence that the Bank of Japan can cite for evidence that there is a kind of cycle of rising wages and spending that can lead to economic growth. And therefore, it can continue with its cycle of rate hikes. And I think if you look at the market pricing now, you'll see that investors are kind of catching up to where BOJ watchers have been, expecting like about an 85% chance of a rate hike by January, with December the favoured month.
Also a powerful argument here, Paul, for Prime Minister Shigeru Ishiba to start rolling out some stimulus. What might we expect to see on that front?
Well, I mean, it would help if there was a kind of weaker result to justify a big spending package. I think the bigger picture for Ishiba is he's had this terrible election result. He's got to be seen to do something, to take some action, and he's got to shore up his minority government. So I think unrolling a stimulus package with measures that offer something for voters struggling with the inflation. We're going to probably see handouts for low-income families, a return of subsidies on energy costs, and I think this will help him to shore up support for his leadership.
All right, Bloomberg economy and government editor Paul Jackson there. We have more ahead on the Asia trade. This is Bloomberg. Even as Donald Trump unveils more controversial cabinet picks, one name still stands out. Elon Musk set to lead a yet-to-be-created Department of Government Efficiency alongside Vivek Ramaswamy. Bloomberg Originals has been looking into how Musk's new role may open up glaring conflicts of interest.
In a dramatic political comeback, Donald Trump will return to the White House. And if he's going to share the credit for his victory with anyone, it's this guy.
Where is he? Come on up here, Elon. Come here.
Elon Musk, known for selling cars, making rockets, became one of the biggest political donors in American history.
This is like a mutually beneficial business arrangement, right? Trump got money and got elected. Musk gets sway over the federal government.
This mutually beneficial arrangement includes a new role for Musk that raises a whole host of potential conflicts.
I think the funniest name is DOGE, the DOGE, Department of Government Efficiency.
Musk wants the federal government to mostly get out of his way. Tesla is a electric car company, and it very much would like the federal government to approve its business in robotaxis, driverless cars.
While pushing for less federal oversight, Musk also stands to gain billions.
Elon Musk owns a major defense contractor. It's called SpaceX. The U.S. government is their most important client. He would like as many more contracts as possible, and would like a president who would say, create a new Mars program and hire him to send the rockets up.
This is Trump 2.0. Like the sort of old rules of conflicts of interest may be out the window here.
And subscribers can see that report in full on the terminal or at Bloomberg.com, and it'll be on the Bloomberg Originals YouTube channel later Friday. Now let's take a really quick look at what we're seeing in markets as China futures are pointing to declines at the open. Of course, we're keeping a close watch on data out of the Asian giant in the next hour. Meantime, it looks like further declines on the S&P futures. That's it from the Asia trade. Our markets coverage continues.